On December 10, 2008, in the privacy of his Manhattan penthouse, Bernie Madoff gathered his two sons for what would become the most devastating confession in financial history. The 70-year-old investment mogul, whose name had become synonymous with Wall Street success, looked his children in the eye and delivered words that would shatter not just their world, but the entire global financial system. His investment advisory business, he told them, was nothing more than a colossal Ponzi scheme that had been running for decades. $50 billion had vanished into thin air, making it the largest financial fraud in human history. As his sons sat in stunned silence, Madoff calmly explained that he had been robbing Peter to pay Paul for over 30 years, using new investor money to pay fake returns to existing clients. The empire built on trust, exclusivity, and seemingly magical returns was crumbling, and there was no way out. Within 24 hours, his own sons would turn him in to federal authorities, ending a reign of deception that had fooled some of the most sophisticated investors on the planet. This wasn't just the collapse of an investment firm. It was the unraveling of a lie so massive, so carefully constructed, that it had operated in plain sight for 3 decades, fooling regulators, investors, and even his own family. Bernie Madoff Investment Securities began its ascent in 1960, when a 22-year-old Madoff started the firm with $5,000 he had saved from working as a lifeguard and sprinkler installer. What started as a penny stock trading operation gradually evolved into one of Wall Street's most respected boutique investment firms. By the 1980s, Madoff had built a legitimate market-making business that was handling up to 10% of the trading volume on the New York Stock Exchange, generating hundreds of millions in real revenue. His firm pioneered electronic trading systems and became a powerhouse in the NASDAQ market, establishing Madoff as a legitimate force in the financial world. But running parallel to this legitimate business was something far more sinister: the investment advisory side of his operation, which managed money for wealthy individuals and institutions, was generating returns that seemed too good to be true. Year after year, decade after decade, Madoff's investment advisory clients received steady returns of 10 to 12% annually, regardless of market conditions. When the broader market crashed, his funds somehow stayed positive. When markets soared, his returns remained consistently steady. This performance attracted an exclusive clientele of wealthy individuals, hedge funds, and feeder funds, who paid handsomely for access to what they believed was Madoff's secret trading strategy. By 2008, his advisory business claimed to manage $65 billion in assets, making it one of the largest hedge funds in the world. The turning point came with the global financial crisis of 2008, when markets around the world began collapsing and investors desperately needed cash. For the first time in decades, Madoff faced a problem he couldn't solve with his usual sleight of hand. Redemption requests began pouring in from panicked clients who wanted to withdraw their money from his funds to cover losses elsewhere. In a legitimate investment operation, this would have meant selling assets to raise cash, but Madoff had no assets to sell. The money wasn't invested in stocks, bonds, or any other securities as he had claimed for 30 years. Instead, new investor money had simply been deposited into a Chase Manhattan bank account and used to pay fake returns to existing clients whenever they requested withdrawals. For 3 decades, this system had worked because more money was flowing in than flowing out, but the financial crisis reversed this equation overnight. By November 2008, Madoff needed $7 billion to meet redemption requests, but his account held only $300 million in actual cash. The mathematical impossibility of his situation became clear, and even the master manipulator couldn't conjure billions from thin air. As the walls closed in, Madoff realized that his 30-year charade was about to be exposed, and there was absolutely nothing he could do to prevent the inevitable collapse. The fall was swift and merciless, unraveling with devastating precision once federal authorities were alerted. Within hours of his sons reporting him to the FBI, agents arrived at his penthouse and arrested him on December 11, 2008. The investigation that followed revealed the staggering scope of his deception, as forensic accountants discovered that virtually no legitimate trading had occurred in his investment advisory business for decades. Instead of the $65 billion in assets under management that Madoff claimed, investigators found only a few $100 million in actual cash, along with fabricated trading records and fake statements that had been generated monthly for thousands of clients. The human toll was immediate and catastrophic, as retirees lost their life savings, charities were forced to close their doors, and entire families saw generations of wealth disappear overnight. Prominent feeder funds that had channeled billions to Madoff faced their own investigations and lawsuits, while the reputation of regulatory agencies came under intense scrutiny for their failure to detect the fraud despite numerous red flags over the years. Madoff himself received a sentence of 150 years in prison, where he would die in April 2021. But the damage extended far beyond one man's punishment. His older son took his own life exactly 2 years after the arrest, unable to cope with the shame and devastation his father had brought upon their family, while countless investors faced financial ruin that would define the rest of their lives. The Bernie Madoff scandal serves as a chilling reminder that in the world of finance, if something seems too good to be true, it almost certainly is, and that even the most sophisticated systems of oversight can fail when confronted with carefully orchestrated deception. This case fundamentally changed how we think about due diligence, regulatory oversight, and the dangerous allure of exclusive investment opportunities that promise consistent returns regardless of market conditions. The scandal exposed critical weaknesses in the financial system's ability to detect fraud, leading to significant reforms in how investment advisors are monitored and how client funds must be segregated and verified. Perhaps most importantly, it demonstrated that trust, once broken on this scale, can never be fully restored, as the Madoff name became forever synonymous with betrayal and financial fraud. For business leaders and investors today, the lesson is clear. Sustainable success must be built on legitimate operations, transparent practices, and genuine value creation, rather than elaborate deceptions that ultimately collapse under their own weight. The 30-year lie of Bernie Madoff investment securities proves that no matter how sophisticated the scheme, how respected the perpetrator, or how long the deception continues, truth has a way of emerging, and when it does, the consequences can destroy not just businesses and fortunes, but lives and legacies that took generations to build.